Want to learn the essential life and health insurance topics quickly? This slides guide is packed with high-priority points to help you study smarter, not longer. Now, let's dive into policy proceeds and settlement options. When we talk about life insurance policies, the first important concept is the entire contract. This means the insurance policy itself, the application, and any riders together make up the contract. Nothing outside of these documents counts, and any changes must be approved by an executive of the company. The insuring clause is the promise of the insurer to pay the death benefit or other covered amounts if a loss occurs. It defines the scope and limits of the coverage. The consideration clause is also essential. It shows that there is a valid exchange. The applicant provides the application and the premium, and in return, the insurer promises to pay benefits. A policy is only valid if this exchange exists. Another key provision is the incontestable clause. After 2 years, sometimes different depending on state law, the insurer cannot contest the policy for misstatements or omissions made by the applicant, except in cases of fraud. Finally, if the insured's age or sex was misreported, the misstatement of age or sex clause allows the insurer to adjust the benefits to the correct amount rather than void the policy. Slide 2, Owner and Assignment Rights, Free Look. The policy owner has a lot of rights, including naming or changing beneficiaries, selecting optional riders, and receiving policy benefits. Life insurance policies can also be assigned. An absolute assignment transfers all rights to another person permanently, while a collateral assignment is partial and temporary, often used to secure a loan. Most policies include a free look period, allowing the owner to return the policy for a full refund within a specified number of days, typically 10 to 30 days depending on the state. Slide 3, Premium Payments, Grace Period, and Reinstatement. Insurance policies include provisions to help keep coverage in force. The grace period gives policy owners extra time to pay an overdue premium. If the insured dies during this period, the death benefit is still paid, minus the unpaid premium. If a policy lapses, it can often be reinstated. Reinstatement typically requires proof of insurability, payment of back premiums plus interest, and must be done within a set number of years, often 3, though some states allow 5 to 7 years. Slide 4, Non-forfeiture Options and Policy Loans. Permanent policies build cash value, and there are several ways to access it. Non-forfeiture options let the owner keep some benefits if the policy is surrendered. Cash surrender means taking the cash and ending coverage. Extended term uses cash value to buy term insurance for a limited period, and reduced paid up allows coverage to continue with a lower face amount without paying more premiums. Policy owners can also take policy loans, which are generally tax-free, up to the cash value. If unpaid, interest is deducted from the death benefit. Many policies include automatic premium loans, which borrow from the cash value to pay overdue premiums and prevent the policy from lapsing. Slide 5, Beneficiaries and Settlement Options. Beneficiaries can be named or changed unless they are irrevocable, in which case the owner cannot make changes without consent. Settlement options define how proceeds are paid, whether as a lump sum, interest option, or life annuity. Some policies include accelerated benefits riders that allow the insured to receive part of the death benefit early if diagnosed with a terminal illness. Similarly, long-term care riders provide coverage if the insured needs nursing home care or assistance with multiple activities of daily living. Slide 6, Dividends and Participating Policies. Participating policies may pay dividends. Policy owners can choose from several options. They can take cash, apply it to reduce the next premium, or let it accumulate interest, which is taxable. Dividends can also buy paid-up additions, increasing coverage, or purchase temporary 1-year term insurance for extra protection. Understanding dividends is important for policy owners who want to maximize the financial benefits of a participating policy. Slide 7, Common Riders. Riders add optional benefits to policies. The waiver of premium rider waives premiums if the insured becomes disabled. Accidental death riders pay extra if death occurs due to an accident, while AD&D riders pay for accidental dismemberment. The guaranteed insurability rider lets the insured buy additional coverage without proof of insurability. Cost of living riders adjust the face amount for inflation. For juvenile policies, a payer provision waives premiums if the payer dies or becomes disabled. Term riders can add temporary coverage to permanent policies, and return of premium riders refund premiums if the insured dies or survives the policy term. Slide 8. Other insured riders. Policies can also cover additional insureds. Child term riders cover the insured's children and pay a death benefit if a child dies. Spousal term riders cover a spouse, with proceeds paid to the primary insured or policy owner. Slide 9. Exclusions and suicide. Life insurance policies exclude certain risks, such as death from war, high-risk aviation, dangerous hobbies, criminal acts, or intoxication. The suicide clause usually prevents payment if the insured dies by suicide within the first 1 to 2 years of the policy. Slide 10. Waivers and impairments. Insurers may include waivers for impairments, excluding coverage for specific conditions. These exclusions can sometimes be removed if the insured's condition improves over time.